Shares of Bank of America seeing a pop today after reporting a very strong quarter. Bank of America beating Wall Street's expectations. Profits jumped 19% year over year to $7.4 billion and 88 cents on a per share basis. BofA's net interest income also rose 14%, meeting expectations at $14.29 billion. But it fell short of JP Morgan's 44% jump last week. For more on the bank's latest earnings, we're joined by Bank of America Chairman and CEO Brian Moynihan and Yahoo Finance's Executive Editor Brian Sozzi. Brian, take it away.
Thanks so much, Akiko. Brian, always great to get some time with you, especially on this earnings day. I was queuing into the earnings call, and the stock price, your stock price really got to move or push higher when you and the team started to talk about a higher or more, I would think, more upbeat outlook for net interest income this year. What gives you that confidence in that outlook?
Well, Brian, it's good to be here. And yes, Alistair Borthwick led the investors through the idea that we basically said that since last earnings call, we felt more comfortable that we'd have a better outlook for NII in the second half of the year than we did then. And it'd be basically flattish quarter to quarter between 14.2 and 14.3, and then be above 14 in the fourth quarter. And that really comes from just the sheer power of our franchise, whether it's we're getting 4% annualized loan growth, which is good on the commercial side especially. We're seeing some card growth. We're seeing the deposits hang in there, even though, because we have such excess funding position, we're not competing for high cost deposits. We put those customers' money into the market in money funds and other things, and we actually even raise money from our customers for other banks to give them those rates because we don't have a use for the cash. And so even with all that going on, we feel good about the NII, and that's basically due to the power of our deposit franchise.
Is this outlook, Brian, your way of signaling to markets that this economy is going to see a soft landing from the various actions the Fed has taken?
Yeah, it's a little chicken and egg. We build our outlet based on the market expectation for rates. But let me back up, Brian, and talk about, we have our research team led by Candace Browning-Platt that does tremendous work. And they basically have the first two quarters of 24 to be slightly recessionary, negative 1% GDP growth rate in the first quarter to 0.5% in the second quarter. So that's a pretty light recession at this point. And they've moved it out from this year into next year, and they've moved the duration to be shorter. So as you think about it, whether it's a soft landing, meaning it never goes negative or it goes slightly negative, I'm not sure people will feel the big difference. And what we're seeing in our customer base is the economy, the spending that goes on in our customer base, which is $4 trillion plus a year, which was growing at 10% a year for all the year 22 over 21, for example, has now slowed to 5%. And that 5% is very consistent with a low inflation, more normalized growth economy in the U.S., kind of what it was in 17 or 18 or 19. And that's good news, frankly, because that means the economy is getting back in line, even though we haven't had massive dislocation in employment, although employment markets are softer than they were a year ago at this time.
Are you surprised by this consumer resilience?
I'm not, honestly, and we've been saying this for a long time. This was going to be the Fed's hardest job, was to slow down the U.S. consumer, because at the end of the day, the amount of stimulus the consumer had, the fact that unemployment has run as low as 3.4%, the fact that wage growth, you see a lot of talk about what's caught back up to inflation, but if you go look at from the pandemic forward, the wage growth from 19, 20, 21 was very fast, and then it fell behind inflation, but cumulatively it's ahead of inflation. And so if people are working and they're getting paid more and they're spending, it's going to be hard to have a tough U.S. economy because of the amount that's driven by that. But on the other hand, you don't want them doing too much and feeling like they're getting behind on inflation, therefore demanding higher wages to get a wage inflation spiral. It looks like the Fed's was probably too late, and they said it themselves, of getting in the game and raising rates. Then they finally moved very quickly, and they've caused that to slow down. And I think that's all good. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. Those same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening, but in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Do you think consumer spending, Brian, will surprise to the upside later this year? We are now finally starting to see inflation slow pretty dramatically in this country. And looking at your results, to your point, you have a lot of people with a lot of money in savings and checking accounts that maybe they could get out there and spend in the back half of this year. How do you see it?
Well, if you think about the last few years, first it was good spending. They bought things because they're pent up in a house and they just had money and they bought stuff, and so they bought a new couch or a new grill or things like that. But you can only buy one of those. So then they started spending on what we called experiences, going out to eat, going out to movies, going on trips, and you still see travel's fairly strong, and you can see the bookings. I think all that, once people have done a lot of that, got a normal summer vacation in for their kids out of school, I think it'll sort of reach what it usually does. Is sort of 3, 4, 5% going faster than the rate of inflation because the wealth of the country grows, and I think that's good. Now, the best news is that the credit worthiness of our customers is still extremely strong, and people keep talking. I get asked about, well, your credit card charge-off rate went up a little bit, or your 90-plus delinquencies went up some. But if you look at that number, it's still far below where it was in 19. And if you and I were having this conversation in 19, we'd be talking about 30 and 40-year record lows of credit costs in our company. And we're normalizing to a very good place. And so I think that also means the consumer has some staying power, the equity in their home. And so, in the end of the day, if companies are making money and employing people, even though it's not as aggressive out there in the markets today on labor, people are going to have jobs and people are going to spend. But I think they're slowing down their activities because, frankly, if all they read about in the papers are going into recession, that kind of has an effect. And if things like a new car cost a lot more in interest rates, or a new home, mortgage rates above 7%, those slow down the activity. But that's what the Fed intended to do.
Yeah, Brian, I think this is the recession that everybody's been calling for a while. It just may not happen. But I want to go into commercial real estate. I looked at your results. When I see your results, I don't hear you calling out big negatives on commercial real estate. Why is that the case for a Bank of America, but a completely different story over at a company like Wells Fargo?
Well, I can't reflect on other people, but we disclose. It comes from what we call responsible growth. For a long time, we've looked at, in the commercial real estate business, to keep that as a percentage of our loans at a size in total, and even the office piece of that, to work with great sponsors of people in the buildings, great real estate owners, and then, frankly, make sure the terms are reasonable. And so as you look across time, that's served us well. So we only have about $18 billion outstanding in office properties, about a couple percent of our portfolio or less. We aggressively re-rate that based on the current conditions. At origination, it was a 50% loan to value. For all the reappraised stuff in the last 6 months, the average loan to value is only 80%. And so, there's stress going on in the system, but we underwrote, assuming that someday there would be stress. And the trends that have gone on about real estate optimization by companies, including our own, have been going on for a long time. It's just they've been changed a bit by the work from home and the 3-4 days a week and all that stuff. Just to give you an example, when we started with the management team in 2010, in our company, we had 130 million square feet that we utilized. Today, we utilize about 60. So this is a long-term trend of efficiency and use of office space that will continue. It just got pushed ahead by the work from home dynamics.
Do you share the concerns that some of your peers have on the outlook for commercial real estate?
I think, look, that's going to be building specific and city specific, and whether people work. And so, as we do a lot in New York, and you look down the street, you walk out on 6th Avenue outside a building, you get run over by people. In town. In other areas, it's not the same. And then there's places, back and forth. And so you've read about San Francisco, a place like that. I think over time, these things will normalize. But I think what we have found so far is we lend to newer buildings and high quality buildings, and those tend to be doing better right now. But I guarantee you, the entrepreneurial spirit of America out there, when the right real estate values come up, people come in and reposition these assets like they've done for many times in the past.
Brian, you also called out something of great interest this earnings season for the banks, the potential for higher capital requirements. And I believe this was your stat. A 10% increase in capital requirements, if that does happen, might lead to $150 billion less in lending. That sounds to me like a big economic blow, or potential economic blow.
Yeah, so I think just to simplify that, if you say that we're at 10% required capital and you go to 11%, that 1% doesn't sound a lot, but that's $16 billion capital, and then you multiply it times 10 again, there's your $160 billion. And some people are saying, well, how can you get there? That's how you get there. So the reality is our lending capacity goes down. If you do this across the whole banking system, and that's why we're all awaiting these rules, but we hope that as the rules come out, they're balanced in terms of international competition. In other words, that right now, America and Europe appear to have the same rules, but they are advanced and we're in standardized. And if you listen, they're saying, well, we're going to go away from the models and all those things. That was the basis of Basel III, to get to advanced. So our advanced RWA are 1.4 trillion, our standardized are 1.6, so we have to use the higher under America's rules. That's not true in other locations. And so we have to be careful about keeping the balance and the competitiveness of the U.S. banking system, which is key not only to America, honestly, but it's key to the whole world, because the strength of our banking system actually helps the world prosper. The second thing then is the capacity inside the industry versus outside the industry. And so if you think about outside the industry, you have half the mortgage loans are done by non-banking companies. You have the new private capital funds being formed. Will those companies perform like we performed when the pandemic hit and $70 billion of loans came on our books in 3 weeks from our customers in demand? Will they be able to have that kind of shock absorber system? Will they be able to behave and absorb the turmoil that went on earlier this year? That's not clear to me. And the history has been paved with companies that have been in these businesses not been able to stand those shocks. So, I think that it's good for the banking system to have a lot of the economy running through it, but using the capital markets to lay that off and using the investor system to lay off, loan syndications and things like that. But if you make the capital rules so tight in banking, the stuff gets squeezed out. So remember, on an international basis, this is effectively a trade negotiation that's going on. If the rules are easier in mainland Europe than they are in the U.S., however you get there, whether standardized, advanced, or how you count the eggs and things like that, the reality is American companies will have a higher cost of borrowing versus European companies, of which they are engaged in the same competition and supply chain for large companies, or large companies would have the same costs. And so I think that's why we have to be careful with these rules. A, international competitiveness, and B, making sure that we keep the balance right of how we treat the U.S. economy. And I hope and I believe, and there'll be, in the aftermath of these rules, there'll be a lot of discussion about what are the pluses and minuses of these rules.
Well, Brian, before we let you go, you're plugged into the regulatory scene. Do you think regulators will overreach with these rules?
Well, I think I look back and the statements have been made by the chairs of the Fed on many occasions and by the vice chairs of supervision on many occasions, including in the Obama administration, the Trump administration, the current, that the capital industry was about right. And so we worry that, the idea of we need to have more capital is coming from, something that just says there's no downside to it, and that's what we try to raise the attention. But, in the end of the day, the rules will come out. There'll be a lot of discussion about them. There'll be a lot of understanding of what actually is in the rules. Right now, it's speculation. And I think we have to be balanced. As we have to be balanced as a. I've been in CEO for this is my 14th year. I've been in banking my whole life. I've seen the wonderful things our industry does for America, and I've seen the downside of our industry. And matter of fact, the non-banking part of our industry, which was the heart of the financial crisis, those weren't banks, weren't under the same capital regimes, and basically a proof point of why you got to make sure the stuff stays in the system. And so we've seen all that happen, and my colleagues have too. And we're saying, give us a fair set of rules that allow us to be competitive among ourselves with the non-bank providers and with Europe, and we'll deal with them, go on. But let's think this through from the broader prospects, not just more capital is better.
And investors, Brian, have seen a lot of steady, consistent, good results out of you and your team at Bank of America a lot of those years. We'll leave it there. Bank of America Chairman and CEO Brian Moynihan, always good to see you. Appreciate it.
Thank you, Brian.